My name is Ben Leese, and I am the President and Chief Investment Officer here at Delphi Advisors. Today, I'm going to be talking about surviving the current market volatility that we're seeing today. And I'm going to try and offer some tips on how to avoid some of those common pitfalls that we tend to find ourselves in, as well as how to avoid some of those people that are out there just looking to profit off of our heightened state and emotion and take advantage of the current scenario. But before I jump into the content, I want to take just a moment and address just a couple of quick items. First, this is not typically the quality of presentation that I prefer to do. Me just talking with a presentation behind me. I very much understand the responsibility that I have to my clients. And I like to make sure that the quality of my work reflects that level of responsibility that I take on for them. But based on everything kind of going on right now, I'm prioritizing getting information out over presentation quality and the details of the presentation itself. So please just bear with me as we go through this. Second, although this presentation may be focused on markets and investing in portfolios, I think it's very important that we take just a moment and acknowledge the turmoil that a lot of people are in, a lot of people are going through right now, both physically and economically. My thoughts and well wishes go out to all those that have been affected by the unfortunate events and by the coronavirus and all the implications that it's had on our society and on our families themselves. So let's talk about surviving market volatility and how to navigate the tumultuous times, this environment that we're currently experiencing. The reason that I titled this presentation as an investor alert is because it's times like this that really make or break our investment returns. And I'm not just talking about over the next 12 months. I'm talking about investment returns over our entire lives. The decisions we make right now, today, can have effects that will last our entire lives. And there are a ton of factors and many people out there who are working against us, taking advantage of the heightened state of volatility and the emotional state we all find ourselves in right now. And I'll get to these factors here in just a moment, but for now, let's take a look at what I mean by the decisions we make right now can affect the rest of our lives. This graph illustrates returns of different investment portfolios, different asset classes over the 20-year period ending in December 2018. This information is put out annually by a company called Dalbar, that's D-A-L-B-A-R, that studies investor returns, asset class returns, and investor behaviors. The period from 1999 to 2018, that 20-year period, was by far one of the most difficult 20-year periods we've seen in recent history. But even though it was so incredibly difficult, portfolios still did pretty well, despite the environment that they were in. The S&P 500 annualized 5.6%, and blended portfolios that combined the S&P 500 with the aggregate U.S. bond market weren't too far behind, really. The 40/60 and 60/40 are representations of those blended portfolios, and they did pretty well, just a little bit behind. Even the aggregate bond market, right, just bonds, no equities, annualized about 4.5% annually. Not too bad. The really startling number that you're going to see on this graph is that average investor return number. Over this very same period of time, they annualized just 1.9%. Let me repeat that. Over this 20-year period of time that the S&P 500 annualized 5.6%, your average investor did just 1.9% annually. Right? That's almost a third of what the S&P 500 did. Didn't even keep up with inflation. So let's take a look at what this means for an actual portfolio, right? Actual numbers here. If you started this 20-year period with $10,000 and invested it in just the S&P 500, you'd have ended with a touch under $30,000. That's a gain of almost $20,000, right? Almost tripled your money. while the average investor would have made less than $5,000 gross during this exact same time period. By investing in the S&P 500 over the same time period, over this 20-year period, you'd have ended with more than twice as much money as the average investor did. So how does this happen? How does the average investor underperform so badly in comparison to even the portfolios that they invest in? The answer is really far more simple than you might expect. It's volatility. The graph that you see here is of the S&P 500 during that exact same 20-year period. And as you can see, this was a tough 20-year period, right? You had to go through 2 bear markets, multiple corrections. I mean, these were drawdowns of over 40%, over 50%, and a number of them over 10%. The reason that the average investor did so poorly over this time frame was because when volatility heightens, right, increased volatility, our emotions kick in, and we make changes at times that we shouldn't be making changes. Right? They might make us feel good in the short term, but they're not always in our best interest in the long term. But, it's not all our fault. Almost everything around us, including people, are working against us, and they're taking advantage of these types of situations. The markets are working against us. We already discussed how the volatility is very unpredictable, but even when things get bad, markets have a tendency to treat us just a little bit worse. Kick us while we're down, if you would. The media is another one. It just feeds off of the negativity and takes any opportunity it can to capture ratings. And they do this through exacerbating fear and ignoring any positives. I mean, fear sells so much better than moderate news or even slightly positive news. If they can exacerbate that fear, their ratings will definitely spike. The people around us even have a very negative effect on us, and that's because their emotions get heightened at these times too. And we talk about it, and it's very reflexive in nature, and you feed off each other. The term misery loves company is very, very fitting here. And this plays into how our own emotions treat us. They cause a lot of problems. Humans, we're built for survival, right? We have survival instincts deep within us. We're not built to maximize our investments in global capital markets. We're just not. The first sign of volatility, first sign of fear, if you would, it's built into us to run. That's the absolute first thing that we do, and it's the worst thing that we can do when it comes to investing in capital markets. And lastly, when we do experience increased volatility and this heightened emotional sense, the financial salespeople come out of the woodwork, and they sell products that may satiate our need in the short term, make us feel better in the short term, but may not be in our best interest in the long term. And they don't have any responsibility for that, right? They sell us products, and they don't have to be accountable for that because they don't have a fiduciary standard in most situations. These are things like annuities, real estate investment trusts, master limited partnerships, or just far more conservative mutual funds that can make them a good profit by getting us to turn our portfolio. Again, most of these are insurance salesmen or brokers, and they're not held to that fiduciary standard. They don't have to do what's in our best interest. When they see an opportunity to make a commission, they take it. Pure and simple. This chart here kind of demonstrates that concept of financial salespeople and when they make the most sales. It outlines annuity sales by year. And as you can see, whenever we see increased volatility, annuity sales rise. Look at 2002, 2003, 2004, 2007, 8, 9, 2011, 2015. And those red numbers that you see on that slide are the S&P 500 returns around those time periods where we see that increased annuity sales. So why do we look at annuity sales? Well, annuities are pitched as safe, secure, or in many cases guaranteed investment vehicles. They're not even investment vehicles, but States have even outlawed those terms in selling annuities, right? There are a lot of states say you're not allowed to use the words safe, secured, or guaranteed when you do sell these products. And that's for a very good reason, but I'm not going to get into the inner workings of annuities right now. That's incredibly complex and probably a presentation on its own, but they're a very good indicator of what salespeople are doing when volatility does kick up. And there's only two things that annuities are really guaranteed to do. First, they're guaranteed to give you very low returns over the rest of your life. And second is they're guaranteed to give the salesman a pretty dang large paycheck. So what should you do to try and avoid these pitfalls, right? How should we go about our lives during these times and make these financial decisions? Well, first, in my biased opinion, as Delphi Advisors is my company and it is a fiduciary advisor, I suggest that you find a fiduciary advisor that you can trust, someone who cannot sell you products or make any commissions. These are pure and simple conflicts of interest. If someone sells you a product, they're not acting as a fiduciary. You cannot collect a commission if you're acting as a fiduciary. And if they tell you otherwise, they're at worst lying to you and at best just twisting the truth for their own benefit. Second is you gotta ignore the media. They're not out to help you. They're not out to help anybody. They're out for their own ratings, pure and simple. Even the experts that they bring on are strategically picked to enhance that heightened sense of emotion and draw people in ratings. Again, fear sells. They're not out to help you. Pick an investment strategy, a portfolio strategy that you're comfortable with. It's important to have a productive portfolio strategy, right? That goes without saying. But it's just as important to be comfortable with it. I tell all my clients I can put you in the absolute best investment strategy ever created, hypothetically, of course. But if you can't stick to it through the volatility, right? If it provides high-level volatility and you can't stick to it, you will never realize the returns that it will provide. It's very simple. You got to find something that works and you got to stick to it. And that leads into my last point here. You have to stay disciplined. No matter what the volatility, you have to stay disciplined. This is by far the most important thing you can do to ensure good long-term returns. Stay disciplined. So that concludes the presentation today. I really hope it was helpful. I'm trying to get as much information out as I can during these tough times. If you have questions or have other topics you'd like to see a presentation on or have questions about, please give us a call, shoot us an email. You can visit us online. We're here to help, always happy, and conversations never cost a dime. Thank you so much for taking the time to watch this. Good luck out there. I know it's a bit of a circus. Take care, everyone. Thank you.